This is Tom Asprey with the Viper Report, a 007 year-end target for the S&P 500. We're getting to that time of the year where all the Wall Street strategists are forced to give their year-end targets, and as I've said for many years in past writings, it's a thankless task. And it's not helped by the fact that many use fundamental rather than technical reasons to come up with those targets. Long-term readers will know that I often analyze these targets, and it can be very helpful for the year ahead. Let's take a look at the past couple of years. This is a SPY chart, weekly chart going back to 22. So you can see for 2023, the year-end target was 407.80, which was only a bit higher than we closed in 22. It actually acted as pretty good support in the October 23 correction. We saw a key reversal up here in July and a pretty orderly correction, got close to the Stark bands and back off to the races. 2024, so we closed, about 100 points above what their target was. In 2024, the year-end target was 486.10. And you can see we moved above that early in the year and stayed above it throughout the year. And now we're at 607.81. So a big difference from their year-end target. The AD lines gave you a very bullish signal here in late 2023 and pretty much stayed bullish throughout the end of the year. It turned down last week, but is still clearly positive. No signs yet of a major top. There have been a number of years when the analysts have been really wrong for a year or two in a row. So this is the case this year. They were way too bearish on 23 and 24. And here's a breakdown of some of the individual. Ed Yardeni, 5,400. He's the closest, down to, J.P. Morgan, which is 4,200. And of course, we had a bunch of bears we talked about early in January of 24. That we're looking for 3,500. So that's interesting. Today's focus is on Wells Fargo's target. You can see right here they look to be about above 4,600 somewhere for 2024. This is a Forbes contribution from January of 2024, and my tongue-in-cheek, this reason's not to buy stocks. In 2023, I was convincing everyone to be in the market. It was very bullish, and that growth in particular was going to lead. And coming into 2024, pretty much we still had that bearish inflation tinged comment from a wide variety of analysts. And you can see down here, of course, I'm based on the advanced decline line. You don't get much more of a bullish chart than you do of this chart of the Qs. Completed this correction. Nice orderly sort of correction. October of 23 shook the remainders out, and we broke out to the upside by the end of the year. The on advanced decline line confirmed the breakout. OBV was positive, so I was not looking for a flat year in 2024. In October's 20th contribution to Forbes, I wondered whether you should be worried because at that point everyone was starting to raise their targets for 2025. And, many people say, well, you've been pretty spot on. What does that mean? And, I thought that was pretty, indicative of a trend to come. We've had these before. Last time was really in 2018. And I wasn't worried then. Now, a somewhat different story. This is the table for this Monday copy of the Viper ETF and Hot Stocks Report. This is a rundown I give to my clients, showing them the key levels here. And lots of data here. You can see that all the AD lines except the Russell are positive. None of them really, the S&P has declined and pretty close. We'll get into that in a second. But really what I want you to focus on is, how close they are to the weekly Stark bands. Remember the Stark bands I've taught a lot about them, and they're available in a number of services, including Yahoo for free. And you can see we're now 2.2, 2.7%, and basically these stock bands have been reached over the past couple of weeks. The IWM, the Russell, pulled back sharply, so it's dropped to 6%. So that's getting into the range, along with, the percentage above the 20-week EMA that are signaling the market is extended on the upside. So far, no sell signals, so we'll be watching the daily AD lines to see if they go into the corrective mode. And you remember a couple weeks ago we successfully, there was a bunch of bearishness after the election pop, but we never got confirmed correction sells and don't have them yet either. Looking at the weekly charts, new highs in the Spider Trust and the S&P. AD line still in a very positive trend. It turned down this week, even though the market was higher. So you don't see that too often, and that sort of behavior is something you want to file away and keep an eye on. Similarly for the stocks only and for the NYSE all still positive. The action last week, however, was not as positive as some of the weekly gains might have indicated. So this is based on the S&P AD numbers. Pretty much they were negative all week. And, on Friday, for example, 16% of the S&P stocks were lower. 1,500, had a positive day on Wednesday. The rest negative. QQQs did much better. If we look at the daily chart, you can see the Spider Trust here, getting close to its upper trading channel, as well as the R1 is at 614.31. I think that's a possible target this week ahead. I'd get more concerned if we got like up to 626, which is the R2. 20-day moving average is rising, positive, so that suggests it's too early for a full-fledged correction, but 597 is still a few percent below where we are. 50-day at 585. So you can see the S&P 500 AD line closed fractionally, and I mean like four advances above its moving average. The stocks only has crossed below it, not by a lot, and the all has still above it. So that's also the all, of course, has all the bond funds, etc. And as bonds move higher, that advancing bond funds is a plus. The QQQ, of course, had a great week. Closing up 3.3% above the yearly R2, and heading up towards that Stark band. AD line, still strong, shows no signs of a top. Some people were, what happened in late 21-22, we had a top in the AD line and then a drop below that low, and that was a decline we sidestepped and we wanted to sidestep. On the plus side for the Qs, you can see is the move above its moving average and its prior peak. So it rose sharply last week. Let's look at the growth value chart. Actually, before we get to the growth value, let's look at the daily chart. You can see the daily trading channel we closed above it on Friday. A 0.9% gain. AD line still strong. We're bumping into resistance here. And the daily RS also indicates that the Qs are now leading the SPY. So typically what you'll see, like we saw, last April, May, we had that sell-off in April, you'll see that move above it and possibly back to its moving average. And then, we saw what happened in the May, June, and to early July period. That was a time to be in the QQQ and growth. The growth value ratio took a strong surge to the upside. The weekly ADs have moved back into positive territory here. So, it could still reverse from here, but another higher close will complete that bottom and will again favor growth. It's been a tough game in here since the surge. As I mentioned, at the start of July, we peaked out, and it's been choppy since then. New high, new low on the NASDAQ composite. Still showing a divergence. Multiple divergences here. A slight uptick in the new lows here at around 108. So, we get back above 230, 300. That'll be a more negative sign, an indication that people are starting to dump the NASDAQ composite stocks. The NYSE does look much better. It picked up the new lows also to 58 on Friday. That was the highest level we'd seen in a week or so. The divergences are not as severe in the NYSE composite. The VIX measures volatility in the S&P 500, VXN on the NASDAQ 100. They're both still declining below their moving averages. That's still a plus for stocks. So first change in that would be to see a move above those moving averages and probably above, say, 23 in the Qs and back above whatever this peak was right here. It looked to be about 18. There were a couple of weekly doji sell signals in the small cap indices. So this is the IJR. We formed a doji a week ago, and last week we closed below the doji low. So after a nice run to the upside, that is something that you can't ignore. You see the volume picked up on the decline. We've been lower volume in the prior 2 weeks, higher volume here. AD line is still positive, but it's also declining, suggesting you get back to the 220 area and maybe even the 20-week at 117.50. I don't think the longer-term trend has changed, so I think that if we have a correction going into early 25, it'll probably be well supported. But for those of you who want to take some nice profits, that's your choice, is to see whether you want to ride out a move of, say, 3 or 4% to the downside. Of course, IWM has a greater percentage of lower quality small cap stocks, and you can see the 20-week EMA is at 223. We're at 238. So that's 15 points down to the 20-week, and so that's more like closer to a 5% pullback. As I mentioned before, one of the best in terms of targets has been Ed Yardeni. He feels the same way I do, that too many bulls are on the surface right now. He'd raised his target 3 times during the year, and he started out with the highest target. So, he started out with 5,400 and 5,800, 6,100, and he thinks stocks are going a lot higher into 2030. But and the Bitcoin also, has got him a little worried. One thing that's interesting here was the, investors' intelligence ratio was at 0.23. That's 2.3 times as many bulls divided by bears in mid-October. Now 3.9. So 62.9%, are bullish. The AAI numbers are not that, extended. Let's take a look at them. So if you want to follow these, just hit Google or whatever your search engine is, AAI survey. Numbers come out in the middle of the night on Thursday morning. They're usually out by 2 or 3 in the morning when I start working. And, you click on that and it takes you to, this latest reading. Thought it was significant. We were looking for this correction. We've been talking about it. We went from, 48, actually above 50, down to 37. Perfectly coincided with this pushed to the upside 48.3. So you can see in this week's 48.3 up from 37. That pull back into 37, was a sign that was, to spur the market higher recently. The bullish high has been 59.2. Bearish high has been 38.6, and we're at 37. We were at 38.6 a week ago. So maximum bearishness a week ago, and but you can check this out. And if you click on this little link here, you get to see what the readings were for about the last year. You can see it was 50.8 in September, and that was, we had that little setback, and in August it was even higher. Let's look at some of the T&J watch lists. You can see that 70.2% of the ETFs closed above their pivots, still in positive territory. There were positive news stories in the hedged ETFs, HEDJ and HEZU, with sells in XOP, Remax, rare earths, small cap, energy, and TBT. All these numbers are looking pretty good, but for the growth, we have 80% DT, but for the value, only 18.2. All right, leveraged ETF still the place to be on the long side. No signs of new buy signals for the short, but we could see those in the next few weeks, maybe before January. And the daily chart shows you that SPXL is still positive based on the daily and the weekly. But if you look at the 260 chart in more detail, what I try to teach my students is, you can see this is bars are 260 minutes. So back here on Thursday we pushed up to a high here, but then closed pretty much flat to down for the period. Similar sort of thing also on Friday. That suggests some sort of exhaustion or distribution maybe on the upside here. So that bears watching. The pivot for as 187.96. So that's a level to watch next week. Not a lot of sectors are still above 50%, so that's a little surprising. 91.7 in XLY, 50 at XLI and at XLP, and health might be close to a bear market bottom with UNH stuff. It's down to 8.3. You can see that about the only other thing we got that low was in the XLK. Got down, I think, not in this chart, but has gotten that low. So XLF still strong, XLK 75, XLC, one of our stars, 83.3, and then both the XLU and the XLRE at 33.3. So and XLF was down 1.8 for the leaders were XLY up 4.7, XLK up 3, and XLC. And of course, the big loser, was energy. Not a lot of new signals. XOP weekly and 3 day. Also 3 days in the XLU, the utilities, and also in the XES, which is another oil and gas ETF. And still some red down here, healthcare and materials and semiconductors. Still have a weekly DTS. The daily and 3 day are positive on SM&H, but it's still sort of range bound. An important thing, note these tables, you can see the yellow here is an indication that they're above the weekly Stark band. So XLC is one of those. You can see that XLF has come down into this good support here, and its pivot, which is at 49.66, closed at 50.40. Doesn't we can see a little sell volume here, not too bad, not as negative as the buy volume was in here. On the sector list, you can see there were new 3 DTS signals for Broadcom, ABGO, McDonald's, and Nike. Interesting combination. And, a bunch of sells here. And if you look at the graphs here, really liking, you can see that this is, the RS plot here would have kept you out of energies last week. Some of the other indicators did look better. And industrials, it's not a good sign that we had an uptrend here that's been broken. I was looking for some industrial candidates, but I'm a little less excited about it now. Consumer discretionary still screaming along. Staples maybe trying to bottom if it can close higher in the next week or so. Healthcare, no signs of a bottom. Financials, you can see we broke that moving average, so that's not in and of itself a reason, to get negative on the group. Would like to see this flip back to positive in the next week. Technology has flipped back to positive. Communication services, yep, still looking strong, though overbought based on the Stark Band analysis. And then utilities and REITs, real estate, both negative. The themes list has a bunch of different groupings that Jerry spends a lot of time developing. Robotics, 66.7. I'll point out the good ones. Cybersecurity, also 88.9. It looks quite strong. Future Med, not so much, at 62. And let's go scroll down here a little bit. Ground transportation looks pretty negative. JB Hunt, NSC, and CSX are the only green spots. Air transports looks even worse. Retail looks quite good. Dollar General flipped back to a weekly DTS. Only Target, is negative at this stage. Leisure also. MGM is all red across the board, but Hilton's okay, and ING not doing too bad. So infrastructure kind of neutral heading into the new year. Aerospace, still getting hit on the cabinet news, 25. And then NQ largest, you can see Broadcom 3 and a weekly DTS. Microsoft also positive. And in the Dow stocks, GS, Goldman Sachs at a 1 hour. I don't place a lot of emphasis on that unless it morphs into a 4 hour. And lastly, AI mixed holdings are sort of secondary ones that you may not have heard of. I certainly had when Jerry came up with, when Jerry came up, but you can see 100% weekly, daily, and 3-day. So a good one to look at. On the Viper report, we posted an early sector list as of Thursday's close. If you want to look at this in more detail, you go under the Viper report, and this list will come up here shortly if I haven't had too much bandwidth. And here you go. And then, of course, you can download it if you would like. Gives you all the data with 1 day's extra data. Also, if you are interested in becoming more of an expert in the stock market, still suggest you consider our class in technical analysis in the advanced decline line. I think it will improve your performance in 2025. Talk to you next week. As always, comment back to me at Tom at Viper Report things you like and didn't like about today's video.